I'm Alan Kenny, Managing Editor with REIT.com, coming to you from San Diego at REIT World 2012, NAREIT's annual convention. Joining me is Stephen Marks, Managing Director with Fitch Ratings. Stephen, we've seen a lot of development in the multifamily sector already among REITs. Where else do you think we'll see some going forward?
Yeah, thanks for having me, Alan. It's something that we actually published on a piece on in June. It's true, multifamily development is up. We're seeing very limited development in the rest of the sectors. The one place where there has been a pickup other than multifamily has been in industrial. However, a lot of that industrial development has been more build-to-suits as opposed to spec. In addition, CBD office, we have seen some development, but for the most part, retail is down, very low levels, healthcare is down as well.
So you're going to analyze a REIT today. What are some of the major issues that you're looking at in terms of credit quality?
I think a couple of things on the macro side. The first thing is certainly the fiscal cliff and creating a lot of uncertainty in terms of companies choosing or not choosing to make decisions this year and into early next year. The second thing is just more broadly the economy. The economy ultimately drives demand for commercial real estate, and if the economy continues to bump along slowly, then commercial real estate, probably with a 12 to 18 month lag, will bump along slowly as well. So those are the two primary macro issues. Micro, it really comes down to liquidity, access to capital, and quality of assets are probably the three primary things that we're looking at, in addition to items such as leverage and fixed charge coverage.
And in the lending markets, there's been quite a bifurcation based on asset quality. Is that still the case? And I mean, do you see that change anytime soon?
Yeah, bifurcation is back. It really came back starting really in late 08 and early 09 when the credit markets in general slowed down. And if you're a fan of efficient markets, you probably want there to be some bifurcation and some selectivity and discrimination on the part of lenders to really lend to good assets. And one of the things that created some of the issues that the commercial real estate market had, particularly on the debt side, was lenders probably due to a very competitive environment, being not as selective as they could be in terms of what assets they chose to lend on. That caused a good bit of compression in terms of spreads and in general the lending terms that borrowers were able to get on A assets to B assets to C assets, and now we've seen that spread widen, and that's a good thing. There should be some differentiation in asset quality in terms of how lenders think about lending to those assets.
CMBS, what kind of role do you see that playing in the REIT market going forward?
In the REIT market, we think it's going to grow. However, that's a conditional answer to your question. It's really conditional on two things. One is how the risk retention rules affect the banks, to what extent they feel like or they are able to put assets on or to put loans on balance sheet. And then related to that is the aggregation risk. To the extent that spreads widen while the assets are being held on balance sheet, that could cause the CMBS market to compress a little bit. However, it is a very efficient use of financing for both borrowers and lenders, and so it will have a place in commercial lending. And the one place behaviorally where REITs may choose to access the CMBS market is, quite frankly, to keep some of the life companies honest, because the life companies have really dominated the mortgage market over the last few years. And by accessing the CMBS market, it does create more of a competitive environment and keeps borrowing costs a little low as it relates to REITs being able to access secured debt capital.
All right, well, thank you, Stephen. Always a pleasure.
Yeah, thank you, Alan.
And for more on this and other REIT news and analysis from REIT World 2012, be sure to check out REIT.com.